clearly the US has never been a key driver, a key engine of growth of the green bond market. It used to contribute between 20-25% of annual volume of issuance of the green bond market. So I would say it's rather a missed opportunity.
Hello and welcome to The Greener Way. I'm your host, Michelle Baltazar, Executive Director of Media at FS Sustainability. Today's episode focuses on the rise of green bonds, one of the fastest growing segments in sustainable finance. And here's what's interesting. There's a school of thought that you don't even have to differentiate between green bonds and traditional bonds. And to join us and share his insights is Johann Ple, Senior Portfolio Manager at BNP Paribas Asset Management. Johann is widely recognized for his expertise in green bonds and fixed income investing. Johann, thanks for joining us.
Thank you for having me.
First, let's start with your background. I know that you've been investing in fixed income for many years, but how has the market evolved and now you are an expert in green bonds?
I've been in fixed income for over 17 years, so I've witnessed the early beginning of green bonds. We've launched our first strategy dedicated to green bond more than a decade ago in 2015, when the market was still very nascent. And we've accompanied the growth of that market over the past years with enthusiasm, I would say. Having the opportunity to see more and more diversification across the universe in terms of sectors, in terms of geographies, and providing a lot more liquidity and depth for investors. We remain particularly optimistic about the dynamic of that market today.
So let's talk about the market size today. How large is the global green bond market now? And where do you think it's heading in the next 5 to 10 years?
I can tell you where I see it now. It's a market that is more than $2 trillion value. So again, a market that has grown significantly over the past years, clearly dominated by euro-denominated issuance. But that's not only about Europe, it's also about plenty of Asian and APAC issuers, about emerging issuers, about Latin American issuers that have contributed to the growth of the market. Looking ahead, I think we are entering in a more mature phase for that universe, which means potentially less records like what we've seen over the past years, but still significant growth. Significant growth coming from historical issuers, still dominated by European issuers, certainly, but with a more pronounced contribution also from other parts of the world as growth and demand is emerging also outside of Europe. So where do I see it? I wouldn't give you a specific figure, but I think I see it continuing to, I would say, converge towards a credible alternative to the conventional bond universe. And I would say that in the years to come, size would matter less than the quality of the project and the quality of the issuer that we see within that universe.
Now, I know that you mentioned earlier that you first launched a green bond product more than a decade ago now, so it's now more mature. So what's exciting? What are the type of green bonds, if you like, that's capturing investor attention?
The way we look at green bond is that not all green bonds are worth the same, definitely. And we have had to accompany the evolution of that market over the past decade, as you say. And I think what is very important is to make sure when you invest in green bond, when you look at green bond, to have a quality of project that have obviously true environmental benefit that reflect the commitment of the issuers from a sustainability angle. This is something that's very important, and this is something that we encourage within the universe. What we've seen in the market, I think that's very interesting, is that it was a market that was mostly dominated by utilities, banks, and quasi-sovereign. And we've seen the emergence of plenty of new sectors over the past years within the corporate segment, which has gone beyond utilities. For example, real estate sector has been pretty dynamic, the transportation or telecommunication sectors as well. We've seen issuances in the automotive sector, and I won't name them all, but I think now the green bond market actually has a level of diversification that enables to be quite appropriate for investors looking. So the green bond market now actually offers to investors not a similar level of diversification to what you have in the conventional market, but a pretty close level of diversification, because most of the sectors that are able of or have eligible assets have been contributing to the growth of the market. Now, from a project perspective, I think it's another important point when you look at green bonds. That's what are the projects that are being financed. And clearly, historically, what we've seen is mostly renewable energy, energy efficiency, contributing to the themes that have been financed by green bond. I think what we could see looking forward also in this market is the emergence of other themes like biodiversity, like water management, which should contribute more to the growth of the green bond market. I might mention as well adaptation, infrastructure, for example. So plenty of exciting things also, not only on the sector side and on the asset class side, but also on the themes that are being financed.
Now, in many ways, when I think about our listeners, you're like preaching to the crowd. They're all within already the sustainability investing world, so they understand the appeal of green bonds. But if you were to play a devil's advocate, what are the key risks that you're watching at right now, whether it's policy, technology, or geopolitics? What could be the downside risks?
For green bond, I think what investors need to understand is that it remains a conventional bond from a risk perspective. So in the end, your key risk when you invest in bonds is that interest rates go higher or credit spreads widen. It's not related to the green dimension of the bond that you might have a difference in performance. And that's very important to have that in mind, which is why we generally say that it can be a good alternative actually to a core bond allocation. Now, the green bond universe has its own characteristics, its own structure, which might make it a bit different than a core bond allocation. It has a stronger focus on Europe, for example. It has a higher contribution to credit. So this means that if European rates were to go higher, or if credit spreads were to widen, the green bond universe and most green bond portfolio could be more penalized than conventional bond portfolio. Beyond that, if you refer to current risk that we see in the market, and one of them being everything surrounding artificial intelligence, actually what we've seen is that the green bond market has not been particularly impacted by the heavy issuance the technological companies have made to finance, their investment in data center. So actually, the green bond market, the fact that it's more exposed to Europe, hasn't seen massive issuances to finance data center, is quite immune to this risk that is potentially surrounding the US credit market.
Now, I feel like every time I do an episode, I have to mention this word, but forgive me if you've heard this 5 times today, but greenwashing. So where are the risks in terms of greenwashing within this asset class? And how does an investment manager make sure that there's a process in place to move away from it?
You're right. And this is a word that you cannot avoid when we talk about sustainability and especially green bond and positive environmental impact. I think the greenwashing can come from 2 dimensions. The first one is the issuer itself. You're financing an issuer that's not truly green. The second one is the project that are being financed by green bond, because the strength of a green bond is actually that the issuer is committing to finance and identify specific project and report on this project. I think this greenwashing can come from the project that are not truly green or the issuer that is not sufficiently committed, which is why, despite all the progress that have been made with different sustainable taxonomy emerging around the world, the EU green bond standards, for example, in Europe, you still need to have or to do your own due diligence to identify credible green bonds, looking at the sustainable ambition of the issuer, looking at the project and how they might, I would say, satisfy or meet your requirement in terms of eligible taxonomy, in terms of project, ensuring that you do not support any negative externality because you don't want to deliver a positive impact at the expense of a negative impact on another dimension. So it's very important as well. And again, you need this project that you are financing to reflect the broader commitment of the issuer. So this is the story about consistency, about credibility, and about meaningful commitment that can help you avoid greenwashing. And greenwashing is a risk, and you can minimize it, but you can never fully avoid it. But the importance is to make sure that you have identified what are the key drivers, I would say, or the key dimension that can lead you to this risk.
Now, bringing it all back to the Australian investor, or let's say a typical super fund looking into an allocation into green bonds, what are the current opportunities? Do you see Australia as well as a source of green bonds, or it's more as an investor in the market?
I would love to say both. Definitely. I wouldn't be here if I didn't think that there is a potential opportunity for investors into green bond. I'd say that the exercise and the exchange we have here are the same exchange that we've had with institutional across Europe over the past years. And I think the key debate that we have at the moment here in Australia is about combining this green bond exposure, this positive impact, this alignment with net zero ambition that they might have with the capacity to deliver comparable returns or better returns than the conventional bond market. And this is, I think, a time when this is becoming more and more possible because the green bond market is being more mature, because we were referring earlier to the size of the market. It is more than a $2 trillion US dollar market because you have more than 800 different issuers. So you can actually build also customized green bond strategy to match potential global aggregate mandate, for example, benchmark, and ensure that you have this benefit of additional transparency and measurability of your impact.
Fantastic. Well, the market is bigger than Australia's GDP, so there's definitely plenty of opportunities there. Finally, what are the misconceptions about investing in this asset class?
If we start with the first one, is that you might lose return, by investing in green bond. And I think, again, I've said it already, but the performance driver of the green bond are the same than the performance driver of a conventional bond. It's a combination of rates and credit risk. And actually, when you look at the universe level, characteristics of a conventional universe versus a green bond universe might differ. And these are this difference that might explain under or outperformance compared to conventional universe. But if you look at the past 3 years, for example, the green bond universe has delivered quite attractive risk-adjusted return compared to a global aggregate benchmark, providing additional return for similar level of volatility, and almost delivered a similar return than a global corporate market with a lower volatility. And I think this level of performance, this comparison of performance, can also be done at the bond level. And if you look at the bonds, there was this misconception about the fact that a green bond would yield a lower yield than a conventional bond with similar characteristics. That's the famous greenium. This greenium has hit a high, I would say, in 2022 at around 7 basis points. So on average, we witnessed indeed that green bonds were slightly more expensive, yet it has completely vanished over the past 2 years. And I think that's quite encouraging for the asset class to say that you benefit from higher transparency without having an additional cost for it. And I think that's the key misconception. The second misconception that we have about this asset class is that it is strictly for sustainable investors. that it cannot be a credible alternative for conventional bond investors. And actually, it has the same risk metrics, so it has the same potential performance driver, so it can exactly serve the same role as a core bond allocation or as a credit bond allocation, whatever focus you want to have as a bond investor, but you can gain it via green bond while having the transparency and the measurability of the instrument in addition, and again, the capacity to identify the benefit that you are financing. So I think, again, it should not be only for sustainable investors. The other misconception that we could mention, so a third one, would be that all the ESG backlash that we've seen over the recent years has kind of killed the appetite for green bond and the potential growth of the market. What I would say to that is that clearly the US has never been a key driver, a key engine of growth of the green bond market. It used to contribute between 20-25% of annual volume of issuance of the green bond market. So I would say it's rather a missed opportunity. It was an opportunity for the green bond market to get even bigger. It hasn't happened. I don't think it will happen at least in the near future. But again, there is plenty of other drivers that can help the green bond market continue to grow, but also support additional demand for the asset class, not only in Europe, but as I mentioned, across the APAC region. And in terms of growth, we should continue also to expect more contribution from different emerging countries.
Amazing. I do know that when I went to the Responsible Investors Association Australia conference, there was a lot of talk around product labeling and the demand for fixed income in this space. So I'm glad to know that we talked about these misconceptions and finally give our listeners a fresh lens on what's happening in this asset class. Johann, once again, thank you so much for coming to the studio.
Thank you very much.
Thanks to everyone listening, and if you enjoyed this episode, make sure you subscribe and share. Until next time, I'm Michelle Baltazar. Thanks for tuning in to The Greener Way.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.